Welcome to the Atomic Level, the show where we decode the matters of wealth one insightful conversation at a time with the rising stars in finance, business, and tech so that you can grow and protect your net worth and, most importantly, your net happiness. I'm Chris Snook, and today I welcome Roger Ohan, author of The Ledger, which we'll be talking about, and the Gross National Assets Framework. Can't wait to unpack his story and the work that he is writing about both here on Substack as well as at broader stages all around the world. Roger, welcome to the Atomic Level.
Chris, it's a pleasure to be here. Thanks very much for having me.
It's always nice when we get introduced by mutual acquaintances and friends, and your work kind of precedes you through a man I respect deeply in James Godfrey, and we've had him on the show several episodes. He was actually 007, which was very fitting for his English accent. But you are currently in Barcelona. But talk to us first about kind of the man and what shaped his worldview. We'll get into the work as we always do on these. But as we let the room kind of fill up with guests, and if you're listening to this on replay, just kind of backstory us on Roger and the man and what his worldview was shaped by to this point.
Sure. So I did the standard things. I went and got a degree in engineering, and I didn't like engineering, so I went got an MBA, and I started working as a trader for a little bank called Chemical Bank, which is now called J.P. Morgan Chase. I lucked out. In life, it's always better to be lucky than good. It's good to be both, but luck is a huge element to everybody's success. And they put me in this really obscure area, which almost didn't exist at the time, called fixed income derivatives. So I started trading swaps. I was one of the first people to trade interest rate swaps. Uh, was part of the growth of that business, and ended up building a big part of the business that is now J.P. Morgan's core fixed income business in Europe. I left that because I thought I could do other things as well as I'd been a trader. So I went off to set up an asset management business in emerging markets. The major emerging market that we were investing in was Russia at the time. Russia was in the stage at that stage going through a huge boom. Everything was being privatized. Everything was booming. And we had an investment banking side to the business. I was president of the asset management company. And we sat in with one person in particular. There's a company called Yukos at the time. Yukos was one of the most valuable oil companies in the world, but the company was really being treated as a cash register by its owner. So it was trading for a very small amount of money. And the corporate finance guys in the investment bank went to the CEO of Yukos, a gentleman called Mikhail Khodorkovsky. And they said to him, look, you're taking the money out of the company, but if you leave the money in the company and turn your company into the cleanest company in the world, your net worth is going to skyrocket. And he sat down and he thought about this for a while. And he went from being the dirtiest company in Russia, dirtiest from a financial point of view, to the cleanest company in Russia with IFRS accounting statements, etc. And sure enough, the value absolutely skyrocketed. He lucked out. He sold a big chunk of his shares, and he managed to get the money out of the country. And then he did something very silly. He decided he was going to take on Vladimir Putin, and Vladimir decided that that company wasn't really his anymore. So he's now in exile. He lives, I think, between Geneva and London, and he's managed to keep a few $100 million in his wallet. So I went. In the asset management business, you go up and down, especially when you're involved in markets that are very volatile. And I moved on into the infrastructure side of the business and the consulting side. So I was an advisor on infrastructure for asset managers. Um, and I now sit on the board of a large hedge fund, a property company, and I'm an advisor to an AI startup. Uh,
On some of those nuggets there, contextualize us to where we were in time. Were we in the 90s where we had the kind of that financial crisis? Were we in the double O's? Where were we when you were doing the thing with UCOS, or where, just so we understand kind of the patterns that you saw unfold or the things that kind of were happening at large around the deals that you were involved in.
Sure. And my mistake for not spelling that out while I was going through there. So I was a trader until 1997, from 97 to 2000, I was investing in Russian equities, which went from, we went from zero to $500 million in assets under management and then back down to 30 because that's what Russian equities did. And that would have been in 2000. And then since then, I've been working, as I said, in infrastructure and as an advisor and a consultant. So for the last 26 years now.
And your clients on the advisory side, outside of the mention that you said there's an AI startup in the mix right now, for that last 25 years, were they banks? Were they asset managers? Were they hedge funds? What was the gamut of your advisory work?
All of the above. I mean, I'm sort of a gun for hire, or I was a gun for hire. I don't do that anymore. I mean, one of the most interesting things I ever came across was a private equity fund. A guy I knew called me up. He said, "I've put an investment in, and these guys look like they're going to take the whole thing down." So we went in, we renegotiated with the other investors. We took over the private equity fund, and we actually turned it into something much better. Uh, I've worked with banks, Credit Suisse, BNP Paribas, Citibank, names nobody's ever heard of. And I've worked on the infrastructure side for companies such as Citco Fund Services, which is the largest hedge fund administrator, and also GlobeUp, which is now part of SS&C on their fund admin side. And I've
Yeah.
sold two fund admin businesses from within there to other players.
So I always like to understand and humanize the person behind the resume with these episodes, and so I ask questions as they occur to me. What is the what is the unique vantage point that you've had working inside of non-unique names? Meaning you listed, all the names that run the world, right? So that's an accomplishment in and of itself, but that's not a unique accomplishment. We have people like that on the show all the time or other shows, but you're unique. And so what was it that you saw, witnessed, led that inside of those client relationships or inside of those operational infrastructures was truly unique to Roger, because the stuff that you're writing about now is unique. And so that's why I'm curious what led to that.
Sure. So, I mean, it's a combination of things, right? I mean, my first career at Chemical Bank was really very much heavy duty fixed income. So, trading hundreds of millions, billions of dollars of interest rate swaps, government bonds, repos, all of those things. And, that's a pretty hardcore business because you get to see absolutely everything. You're sitting there at your desk, and within seconds after a number comes out, whether it's a GDP number or, a payroll number, the markets are moving, and we sat on huge positions, so every second the market could be moving up and down. You could be winning and losing millions of dollars. So that's one thing. So that was really the core foundation. And then when I moved more into the asset management side, I continued to watch the markets, but it's from a different angle because it's sort of like I've sort of got a dumbbell background, right? I've done the really super liquid, extremely high volume on one side. And then on the other side, we're looking at emerging market equities, which are very, very illiquid. Your options on these equities are so illiquid that they sometimes trade, once a month, once a quarter. So I've had the experience on both sides. And then I started looking at the infrastructure side and, moving up into a slightly more senior roles where I was helping companies, um, divest some of their businesses. And, the framework emerged from just various things, whereas I was watching the way things were happening and I was looking at, when the GDP numbers came out. And I would say, but wait a minute, this doesn't make sense. And the point that it really started for me was with Hurricane Katrina in 2005, because to me that was a huge, huge, huge event. And why was it a huge event? Because I think, first of all, New Orleans was destroyed, which was a tragedy. People died, businesses were wiped out, homes that had been built over decades destroyed. Photo albums, which is actually even more important than the homes, gone. So when the GDP numbers came out after that, they didn't reflect a massive destruction of wealth. And that's when things started happening in my, you know, my goldfish-like brain to start to put things together and say, why is it that we're seeing, economic numbers that look actually quite good, but we're seeing the destruction of a city, and that's not reflected in the numbers that we're seeing. So that's when it started to hit me. And then the UCOS example that I gave a little bit earlier, that's really an income statement versus balance sheet question. And that's the angle that I've taken to the ledger. When you look at GDP, from my point of view, that's very much the income statement of a country, whereas nobody's looking at the balance sheet. And that's the framework that I'm proposing in the ledger.
So I think that's a really tangible example that we can all extrapolate out since then. It was happening before then too. But
Mhm,
my way of framing it is we kind of hit peak gaslighting around economics, and growth in the world, let alone in this country. I think within the last several years, especially, right? And this whole Wall Street versus Main Street, and like all that dialogue. What you just said was 20 some odd years ago, 21 years ago.
mhm.
It occurred to you that what was happening on the ground and that reality was not being reflected in the headline numbers. And outside of all the emotional and empathetic reasons why we should have a better, more well rounded way of looking at it, there was also just the pragmatics of being blind to opportunities, because there's always investment opportunities inside of destruction, right? So there's like two sides of that coin. One is, we're not telling the truth. And then two, we're also not creating a visibility where positive change and positive returns could actually have a social impact that matters too, right? We're just papering over it with stuff that'll gaslight people to get them elected or keep us elected, right?
Well, we don't want to talk politics today, right?
And it's not about politics, right? It's about the fact that we
Yeah.
use data that is convenient for whatever our purpose is, and then we conveniently leave off the data that is not to our purpose. And it's not just, it's corporates too, right? It's everybody.
Mm.
So it's not a politics conversation. This is a financial analysis conversation. And you've now really kind of spent the last 21 years, as you've been thinking about writing this book, now that you have written this book, developing this gross national assets framework. So if we get into the operating system of Roger and the ledger, let's start talking about the basics. Build it from the ground up for me. The book link, for those who are wondering, is in the show notes, or it's in the chat right now. If you're curious, you can pick up a copy. Please go do that. But let's talk about it. Let's unpack it for those who are too lazy to read.
Okay, sure. So when something is destroyed, in the example that we just used, New Orleans, or you crash your car, and you go to the repair shop and get it fixed. Let's say it's you don't want to claim on the insurance. So I don't know. Let's say it's a nice car. It's worth 100,000. It's $10,000 worth of damage. You go to the repair shop. You give the guy 10 grand. He fixes the car for you. You are $10,000 poorer. He, the repair guy, is now $10,000 richer. The economy between you two hasn't changed. He's got 10 grand more, you've got 10 grand less. It evens out. But if you look at the GDP, he's done 10 grand's worth of work. The GDP has gone up by $10,000. And that's the starting point right there. And in the book we go through a couple of examples: a house burning down, when you build a bridge between two very underpopulated communities, which might cost a lot of money, but nobody uses it. So you have to borrow the money to build the bridge. And yes, you have an asset at the end of the day. The bridge is there. It's got to be repaired. So that's a future liability. And there's the debt that you borrowed to build that bridge. So between those three things, I mean, obviously, if you've got a bridge that's going between Manhattan and Brooklyn, then that's great because it's going to be packed all the time. But if you've got a bridge that's going between two underserved communities, then that's not so good. And what we saw in Japan, is when the economy started to turn, they started building a lot of infrastructure, tunnels through mountains that, didn't make economic sense. And the best example, I guess, is when you look at China. China was trying to boom.
gonna just say China, they poured more concrete in 10 years than the globe had poured in like the prior 300. And everybody talks about that story as if it's like growth. But if I use your analysis, it might not be, right? So go ahead on
Well,
that one. Ask
yeah,
away.
sure. So, I mean, it's absolutely not growth. I mean, they've spent, you know, I don't have the number in front of me, but they've spent tens, if not hundreds of billions of dollars building cities. And, if you look at the satellite data in some of these cities, they're built for 10 million people. When you have a population of 1.6 billion, you can afford to have lots of cities of 10 million people. But nobody lives there because the work isn't there. They overbuilt in the wrong places, et cetera, et cetera, et cetera. So if you spend $1 million putting up $10 million putting up a building, and you can only rent it out for $50,000 a year, then is that really a $10 million building, or is it something that's worth a lot less? So that to me is destruction of balance sheet.
And to use I love your car example. I love your car example because it's so tangible for anyone. And so then what happened? And again, not speaking specific data, but I know this anecdotally, and the data's out there. Then they permanently destroyed some of these ghost cities,
Mhm,
right? Because there was no one living in them. So then they destroyed them. Well, what does that do? That is another revenue generator because now you have to go demolish. Somebody's getting paid to demolish it, but you're printing debt at the central bank to go pay or paper up the guy who's going to pay. So your GDP numbers go up because now you built a city that no one lived in. And since no one lived in it, now you have to make up for that gap. So the P&L keeps growing. So you blow that city up.
mhm.
Mean the balance sheet's actually getting worse.
Correct. That's absolutely correct. And the whole idea of GDP started during the Depression, 100 odd years ago, less than 100 years ago. And the big problem was the politicians didn't know how much work was being done. So they sat down and they got this guy to look at how he could come up with a metric that would value the flow in the economy. And he came up with a great number, which was, GDP. And for what it's supposed to do, it's amazing. It does exactly what it's supposed to do. The problem is, and the guy's name was Simon Kuznets, and he was, in Washington, and he designed the whole idea of GDP. He said, this is great, but you can't use this for everything. You've got to come up with something else. And then, a small thing like World War II came along, and GDP was again very useful because then you could figure out how much of the economy you could shift from, butter to guns. And for that, it was amazing. But when the world came out of World War II and moved into the Cold War, again, GDP was amazing because you knew how much you could spend to keep the nuclear weapons going without destroying the economy. But you're still neglecting the balance sheet. And it's the balance sheet that at the end of the day uh, determines how wealthy a country is or not.
So when we think about applying this just in other simple use cases, again, that $100,000 car use case is great because the assumption is that car that is purchased for 100,000 is worth 100,000 when I go in to fix the $10,000 repair. The reality is everyone knows it didn't. It depreciated by whatever it depreciated by, even if it
Sure.
happened, even if it happened 5 seconds after I drove it off the lot, right? So the asset actually isn't worth 100,000 anymore, even if that's what I paid for it. Now I put another 10 grand into it, which means I'm out another $10,000 of my balance sheet's cash. The asset is worth less because I repaired it, but I didn't repair it to full value. I repaired it to whatever the market will bear for a car with a accident on it, which will be less than a car that doesn't have an accident with the same mileage. So I put 10 grand basically into something to just preserve further depreciation of my assets. So let's say my assets now worth 50 grand instead of 60. The number on the top line went up because the guy doing the work made $10,000 in cash. So the GDP in that case went up, but the G&A, if I was just using that microcosm, went down by another factor of whatever. And
Yeah.
so if I'm trying to figure out at a state by state level where I live, a county by county level, and I start looking at surpluses turning into deficits, right? We've all seen those stories of, I lived in Arizona for 10 years, and under Ducey, we had a surplus. I think it was $1 or $2 billion. Within a matter of 18 months, when the new governor came in, it was a negative something billion-dollar number. And, we call growth because TSMC or these deals are putting physical infrastructure in Arizona with CHIPS Act with stuff. And there's real infrastructure, real growth, real job creation. So it's not a binary thing. But when you don't look at it through a lens like what you're talking about, how do you make sense of it? So walk us through like some of those use cases in our, call it, states or local governments where they can't just print money out of thin air like the Fed can.
Sure. So I think when I look at the balance sheet of an entity, and I've started at the top level with countries. There's also a chapter in my book that talks a little bit about cities, but basically the framework is starting at the country level, and then we can work our way down. So I define assets in the following way. I think that you have natural assets. So if you have fish stocks, in rivers, if you have forests, if you have oil in the ground, coal in the ground, et cetera, et cetera. So those are all natural resource assets, and they are assets, and you can use them and you can do things with them. Now there is a distinction. If you have a forest and it's properly managed, it's a perpetual asset. It will last forever because the trees will grow. If you have oil in the ground and you pull it out of the ground, it's no longer in the ground. So there is a distinction that we can talk about in a minute, but let's go through the assets now. The second category of assets are things like infrastructure. So, the highways, the railroads, the bridges, all of these things. These things are assets that make the economy function more efficiently. The third category, and by far the most important in almost every country in the world and every state in the US, is human capital. So you and I count as capital because we bring value to the table. All of the listeners out there, they bring value to the table. They do work, they buy things. All of these things count. The fourth category is intellectual capital, so things like patents. You can use those to develop, new technologies, new things that will add value to the country. And the last one is the easiest one. It's financial assets. So, how much money is does the government have in the Fed, for example? From that, you have to take away things which are negatives. So, you've got the assets, which are the government's cash in the bank, but against that, you've got the liabilities. So, all of these pension promises that have been made, the Social Security Fund and the Medicaid funds, and all of these things, these aren't funds. These are calls on the future cash flow. Number one. Number two, the infrastructure deteriorates. And if we don't keep track of how much it's deteriorated by and don't replenish it, then, when we have to rebuild that bridge because we didn't maintain it, that adds to GDP as well. But, we've depreciated the balance sheet. Um, if we've cut the forests down, obviously, and we don't replant, if we pull the oil out of the ground, all of these things take away from the balance sheet. Over the top of that, I think there's what's called, the governance multiplier. So if you have a really good governance framework in the entity, whether it's a state, a country, or a city, then that multiplies the return on the assets. Because remember, these assets can be used to generate value. And if you use them correctly, they generate more value. If the governance multiplier is very high, then the value that's generated is much higher than if it's very low. Let me give you a great example. If you look at Norway and Nigeria, they both had equivalent amounts of oil in the ground. Norway turned their oil into the biggest sovereign wealth fund in the world. It's worth a huge amount of money. It's worth almost $1 million per Norwegian. Nigeria used the money to do something else. And Nigeria is one of the poorest countries in the world. So those are the two extremes. And the whole idea, Norway started their sovereign wealth fund before the money started to flow. So they put in place restrictions on how that money could be spent. So even when there's a crisis, there has to be a super majority in their parliament to vote a change in the a temporary change in the constitution of the fund. For example, during COVID, they voted a temporary reduction in the contribution to the fund from the Norwegian petrol fund. That doesn't exist in Nigeria. But if you go to the country next to Nigeria, Botswana, Botswana has, natural resource wealth. And they've started to do what Norway's done. So what they've done is they've decided to invest in human capital. So they've invested in schooling, in getting their people to be more productive. And if you look at the GDP in Botswana, it's showing steady progress, whereas the GDP in Nigeria isn't showing steady progress because they're burning their balance sheet. They're pulling the oil out of the ground, so the balance sheet is reduced by the amount of oil that's coming out, and they're
So,
not creating an asset against it.
so a couple of things there. GDP is a metric you still think is important, it plays a role, just like understanding your revenue and expenses plays a role in a business. But not as the standalone metric. That's, I think, the layman's version of the short thesis, right? Is that you have to look at the balance sheet as well. Talk to me about governance a little bit, because again, in a nonpartisan way, it doesn't really matter what party affiliation I have or what country I'm in. What are the elements of what Norway did that, because that playbook's out there. That's not like something you can't go find. What are the elements that, regardless of party affiliation, are mandatory for good governance? What have you learned about that?
Well, it's actually quite amazing. I mean, because Norway started their their uh, their sovereign wealth fund before the money was flowing, it really wasn't a huge amount of money that was going in there. So people weren't that concerned about getting their hands on it. And what they did was they put in place an absolute strict set of restrictions that allowed them to grow the capital very efficiently. So the first restriction is that, first of all, without a supermajority from the politicians, they can't change the constitution. They can't reduce the amount of money that's flowing into it, and they can't take out more than the real return from the fund. Second of all, they dedicated the fund to be a perpetual fund. So it's not there for today, it's there forever for to replace the oil that's in the ground. So what they've done is they've had this oil in the ground that was this asset, and they pulled it out of the ground and they've turned it into a financial asset. So their balance sheet has remained very strong. They've converted a natural asset into a financial asset. So the governance is key to that because the politicians from whichever party can't get their hands on it. So if somebody says, well, we need more of this, then we need tax cuts or schools or whichever way you want to go. Well, we have to fund that in a different way. um, and the balance sheet tells us, because we're looking at how this is going to affect things in the future, the balance sheet tells us if we do this, then the future balance sheet is going to be weaker. And that's where I get to the what I call the sovereign share. So when you take the gross net assets of a country and you divide it by its population, you get the value that each citizen, basically think of it as your equity portfolio in the country. And in Norway, it's almost $1 million per Norwegian. To give you an idea, in the States, it's about $175,000. Um, the two countries that are most impressive, because they started from zero, are South Korea and Singapore. And both of those countries looked at what they had. So Singapore is actually amazing because they had nothing. When they left the Malaysian Federation, they had no land, they had nothing. Their people were poor peasants, uneducated, and the government decided that they were going to invest in people because the people were what was going to pull the country forward. And they started with educating them at the primary level, and it's like a several generation project. So the first generation learned to read and write and count, and they could staff the ports, and they had incredibly strict rule of law. So they imported the British legal system, chapter and verse. They used that as their base, and they guaranteed people that if you come here and do business, everything is above board. Interestingly, I'm not sure what his salary is, but the Prime Minister of Singapore, I believe, is the highest paid politician in the world. And the reason for that is they say he's got the most important job in the country. So we need to pay him very highly. The other thing, of course, is when he leaves office, he's not allowed to work in anything that applies to government. So pay him whatever, just to make sure you get the best people. And then once they're done, they're not allowed to come back and drink at the trough again. So
Right.
that's an interesting concept.
No lobbying work for you right after the fact.
Well, they pay them very, very well. I mean, I think it's like $4 or $5 million a year, which is a lot more than the president of the United States gets, which is a much bigger country. So that's how important the job is to the Singaporeans.
Well, and again, there's a whole other conversation there around, different sets of rules for different, different folks and whether it's insider trading, whether it's all that kind of stuff. But let's stick with so the assessments that you do you look at all countries? Like, are you mapping all 194 countries right now? Is there a plan to do that in your roadmap and your work as far as kind of becoming the GA dashboard for people as a data source, as a real-time analytics? Where do you think this work goes from where it is today, where it's evolved from, and what you think you're doing with it over the next several years?
Sure. So, am I going to do all 194 countries? Probably not.
There might be more than
But
that. I don't know if there's 194 anymore. It might be 200, but there's
I I'll stick with your number, it's fine. I think what I did with the first book, The Ledger, is to go out there and build a framework, and I haven't gone into in-depth analysis of any particular countries. There are a couple of countries which I spend a little bit more time on than others. So, for example, I compare Norway to Nigeria, Saudi Arabia, and the UK as petro economies. But I haven't gone into a huge amount of depth. A couple of countries I look at in a little bit of depth, so Singapore and South Korea. And one interesting country that I'll just sort of dive into for 30 seconds and then come back to your question is a country called Nauru. It's spelled Nauru. It's one of the 194. Um, and it's a speck of rock in the Pacific Ocean. And to be honest with you, even though I've been working on this book for a while, if you gave me a globe, I'd struggle to put my finger within 500 miles of it. But in 1980, I think it was, on a per capita GDP basis, it was the richest country in the world. And the reason for that is that um, millions of years ago, there were lots and lots of birds who would nest there. And what do birds do when they nest? They make a big mess. But over geological time, that becomes phosphates, fertilizer. And these guys, basically, their island was made of money. So they started mining the phosphates, mining the guano, and they would ship it out in boats. What they didn't realize was that they were taking their balance sheet and eroding it. And they invested in all sorts of wonderful things like plays that shut down after 3 weeks. If you were a citizen of Nauru, you could get free flights to Australia to go shopping, etc. One day, they realized that the phosphates that they were digging out were no longer of high quality. So the revenue stopped completely. And they went from having the highest GDP per person to zero. And now basically they are a prison island. So if you try and reach Australia by boat and you get intercepted by the Australian Navy, they take you to Nauru and you're kept there until you can either clear immigration in Australia or get sent back to your country. And that's how the country survives today. And that to me is a very telling example. I go through that example in the book. Now, going back to what you were saying earlier about all the different countries, I think I would like to move the project forward. I think it makes a lot of sense. I think there are, like you said, there are 194 countries, so I've got lots of books to write. But I don't think I'm going to go into all of them. I think there are a couple of fairly obvious ones that spring to mind. So the OECD countries, there are 38 of them, I believe, and they would make an interesting comparison across the different because they're different governance systems. Some of them are incredibly well governed, some are less well governed, even though they're all part of the OECD. And then I think contrasting that with the global south. So, the BRICS to start, but all the other large countries in the global south. So those two are probably my next two projects.
Yeah, I mean, inherently, the framework provides a roadmap for a very meaningful open data project, um, and that I think fills a real need in the market because how many times have we all heard listening to this about Singapore in the last 10, 15 years. And there's a lot of, proof in that pudding. But there was also, the freedom index for a while, right? Which was like ranking countries by, how free they actually were. And there was a time at least where New Zealand ranked, I think number one for a period of several years in a row. And phenomenal country, phenomenal resources. During COVID, I wouldn't have considered it to be one of the freer countries, right? But the index didn't change. And so, a lot of this data is either obsolete or not complete or not transparent. And when it comes to the wealth of a country, which is its ability to provide whatever its going promises are to its citizens in a sustainable way, I can't think of a more important metric to kind of have your finger on, as a citizen, as a voter, as a politician, as a company investing assets. Do you consider, like, if somebody was applying your framework and they were in a position of governance, whatever that might mean, right? They were leading a country or they were running a sovereign wealth fund, whatever it may be. Um, is it a return on invested capital equation at the end of the day? Like, is that what we're trying to discipline people to? Because all money is tokenized debt in a fiat system. And so we're ultimately, the money supply increases, which means the debt goes up, which means the balance sheet gets worse, unless we're getting a return on that invested capital, which is debt. So is that what you're moving people to from an assessment standpoint, or is it something else?
So I think it's slightly different. I think you're on the right track, but I'd like to frame it in a slightly different way. I think that when you look at the sovereign share, so how much is my equity in the country worth? What I want to do is see if I'm going to be passing on more equity to the next generation than what I inherited. And if the balance sheet is shrinking on a per capita basis, then the answer to that is no, I'm not passing on a better investment portfolio than if it's increasing. So I'm saying to myself, again, let's go back to the example of Singapore. When or let's take South Korea. South Korea's GDP per capita when they started, after the Korean War, imagine how little capital they had. And now it's one of the richest countries in the world. So what they had was a population that could work, and they had schools that they built, and they compounded the capital by a number of percentage points every year. And as that capital compounds and grows, it can be reinvested. So remember what I said earlier, which was that the biggest component of a balance sheet is the human capital component. And there are ways of measuring that, and there are a bunch of frameworks. I didn't design the frameworks. I'm not clever enough to do that. But there are a bunch of frameworks out there that evaluate how much human capital is in each country. And again, let's take an example. In Cuba, for example, which is one of the poorest countries, and I just published an article on Substack this morning on Cuba because it's very topical. Cuba is one of the poorest countries in Latin America. And Latin America is not the richest region in the world. But if you go to Cuba, they have a higher literacy rate than the US, which is actually quite shocking. They have a huge number of doctors. Their healthcare system is amazing, but they have no equipment. So you can easily get a doctor's appointment. They have nuclear engineers. They've got all of these people. And what these people do, instead of compounding the capital that has been created by their education, they work as bellhops in hotels because the guy who gets a $5 tip in the hotel, you know, gets paid more than the doctor who gets about $40 a year in salary from the government. So because of the fact that their governments is eating their balance sheet, and it's a disaster for the Cubans. But the reason that it's a disaster is that they have all these assets and they don't allow the assets to grow. They destroy the assets by forcing people into the dollar economy, which is, the black market, prostitution, tourism, and the people who receive remittances from their relatives in the US or other parts of the world. So that's caused a huge, sorry, go ahead.
No, no, no. This is a great example. I just want to bring the picture back to life. So, do you see this as like a layered cake type framework? I'm going to bring back some of the things you said earlier, so you can correct or expand. Meaning, like, there's the resources, there's the assets in the ground. So, like, you look at a country, you look at a state, you look at whatever it is, and you go, okay, there's this base level of assets, rare earths, oil, human
Whatever.
capital, whatever it may be, right? Then there's the assets that allow that to be commercialized, because there has to be infrastructure in order to bring that stuff out of the ground or refine it, right? We could talk about Venezuela, right? With all this oil, but no ability to refine it. Huge asset base, huge wealth creation opportunity, but limited because no infrastructure at that layer of the framework to refine it. And then you have distribution, which, again, is more infrastructure, more asset base or not. Who am I connected to and why? Who's my customer base? How do I get it to them? You talked about Nauru, right? Boats going out and taking phosphates, but then now it's just a prison island. And then you ultimately have this demographic asset, which is the people who both consume your resources because they live there and they require that, as well as labor against either your balance sheet or against some other thing, tourism, that doesn't support the real nature of your balance sheet, right?
Yeah.
So how is this a
So
frame that stacks
so
like a layer cake, or is it an ecosystem kind of framework when we visualize it?
like I said, there are 5 different asset types. So natural resources, whatever they may be, whether they're fish in the sea, forests, rare earths, et cetera. Then there's the infrastructure. Absolutely correct. If you can't get the oil out of the ground and can't refine it, it's worth much less. Human capital, number 3, and then intellectual capital, which I think is critically important, especially in, modern countries. I mean, the whole AI um, uh, e- uh, theme that we're all talking about these days is just one example. But all the other patents and intellectual capital that is there. Um, and then lastly, the financial capital. So those are the assets. Over top of those assets, we have the governance framework, which can multiply or reduce the value of those assets. So I think that when you start with I mean, imagine a country with nothing but oil. So they start producing the oil. Somebody comes in, ships it out, and if you've got a governance framework which takes the revenue from that oil and invests it in improving their population and improving their infrastructure. Let's say they build a refinery, so instead of shipping out crude oil, they're now shipping out gas and jet fuel and all these other things. So that's moving it up a level. They educate their population, so instead of having to import engineers from somewhere else, they can have their own engineers. So now these people are local. They're providing revenue for their families, et cetera, et cetera. They go to the shops, they buy things there, and as they spend more money, that sort of creates an ecosystem. So, that's the human capital side of it. So we've started with the natural resource. We've built a little bit of infrastructure, a port and a refinery. We've now got some human capital. So now, because you've got some engineers coming out of the university, they look at the refinery and they go, hey, we could do this a little bit better. Maybe there's a process here. So that starts building things like intellectual capital. And then all of a sudden, this country, instead of just exporting crude oil, is now, helping redesign refineries. And then lastly, some of the money that they've taken out of the ground, they turn into maybe a sovereign wealth fund of some sort or another, or they use it to, you know, build better homes for their population. They do something with the money that compounds over time. And if you have the governance framework over top of that, and again, going back to the example of Nigeria, they don't have the governance framework. So the money comes out of the ground and ends up in a bank account in Switzerland. That doesn't help the country. It helps the person who has the bank account in Switzerland an awful lot, but it doesn't help the country. So I think the governance framework is one of the keys to the framework. The
Yeah,
governance.
if I listen to you, I'm going to make this statement, but I want you to react to it, because this is what's occurring for me. So we live in a world where every country or every state, as it were, has resources. They have natural resources, right? They might be different, but there's not one that doesn't have something that is valuable or could be valuable. Every place has some level of infrastructure, some better than others. But let's say that also is pretty much a given, or there could be a reason to develop that further. Every place has humans because humans live in all kinds of conditions, right? So the human capital is there. the intellectual capital was a big decider for the last thousands of years. But now we've just cognified the planet with hyper intelligent, like in the current state. That is no longer a limiter because now all you need to do is be able to, using the mobile connectivity we've established, the Starlink connectivity that it continues to expand, like the compute is everywhere. We've now basically democratized the smartest person in the room to anyone who wants it. And you don't have to be that smart to ask it questions. Obviously, the better you are, the better you'll get. But you could argue now that we've democratized intelligence. And so, really, if I take your framework and I look at these four levels of other assets, the fifth one is the linchpin. In my like listening to you, I'm going, the governance is everything. Because if my governance framework is going to squander the wealth of these other four assets, it doesn't matter.
That's absolutely correct. And I'll give you an example of a country that started out with nothing, which we just talked about a couple of minutes ago, which was South Korea. Imagine the state of South Korea after the war. I mean, the Korean War was, or I wasn't, thankfully, I wasn't there. I wasn't born. But, it was a wasteland. And all they had were people. So they have no natural assets. There's no real wealth in the land in Korea. So they started with people and they educated the people. And they started building factories. They built universities and they said, we will have so many engineers that they will come up with ideas. And, you've now got all these Korean chaeballs who are, my phone is a Samsung. So um, it's a Korean phone. And they started from basically zero, no natural resources, very low infrastructure because it had all been bombed to kingdom come. Um, their population wasn't terribly educated. It was, really almost peasant level, and they had to start from scratch. They had no intellectual property, um, and they had no money, so they didn't have enough land to grow food for themselves. So they started from nothing, and here we are 70 years later. And, it's one of the richest countries. And you're absolutely right. The governance framework was key. And I agree with what you said a little bit earlier about the Freedom Index. And South Korea, for most of that history, was not a free country. But what the choices that they made were to develop the little that they had in terms of resources, which was human capital, educated so that the human capital becomes more valuable. It then becomes able to do more things at a higher value added level. And, now we end up with, a Samsung phone that I'm talking to you on at 70 years later. So that's three generations. The first generation learned how to read and write and do math. The second generation learned how to, go to high school and things like that. The third generation are now top notch engineers. And interestingly, South Korea now has, a huge number of patents. So I also agree with you that we've now turned, everybody into the smartest person in the room with AI. And I don't think we're quite there yet, but I think we're getting really close. I mean, I think that, AI is still, it's getting there. And I agree with you that we've democratized intelligence in a way that, nobody could have dreamed possible 20 years ago.
Yeah,
Um,
I think the point isn't where we think AI is. It's the point that it never gets worse from here. So,
correct.
however good or bad you think it is for whatever tool or whatever task you're trying to apply it to, this is the worst it will ever be. And the compounding of that improvement is never existed before. The speed of that improvement cycle has never existed at this scale before. So the point is that it doesn't matter.
Mhm.
We can say that we hit an inflection point where now intelligence is no longer a limited resource. It is an abundant resource and it will become more and more abundant. But harnessing that resource will be the decider between winning and losing the future. And governance, not politics, not party, governance, the framework by which I allow things to happen or not against whatever strategy I am doing is the key. And you've given examples of whether they were dictatorships, whether they were kind of state centric or whether they were democratic or something else. There's examples across the world where good governance has worked inside of a different kind of ideology. Um, where do you think the opportunities are and the risks are that are not being talked about right now? Um, in the global order, who has the advantage and why?
Okay, so a couple of things. I think first of all, one of the big risks that we're facing now is, remember, I'm talking about balance sheets. That's my stick. The biggest component of everybody's balance sheet, all the OECD countries, all the rich countries in the world, is human capital. So if all of a sudden I can have the smartest guy in the room times 100 anytime I want, then the value of human capital is going to go down. So, I'm still thinking through exactly how that's going to affect everything. I mean, if in all previous technological revolutions, what we've seen is that the type of jobs has changed, but the number of jobs has continued to remain relatively constant. I have my doubts that this is going to be the same this time around because, first of all, AI is happening so quickly. It's happening within, less than half a generation, whereas most of the other changes have taken a couple of generations. And second of all, we are, like you said, when land was the most valuable thing, then people used their hands. When the hands became something that, could be replaced by machines, people started using their brains. But now it's the brain that's being replaced by the AI. So if we follow the pattern we've been following for the last, 300 years since the Industrial Revolution, we will see new jobs being created. I don't know that that's what's going to happen. If it does happen, then we're moving on, to the next step of the development of our countries. If it doesn't happen and we find ourselves with far, far more people who can't provide for their families, who can't, contribute to society, then I think the value of the human capital that's on the balance sheet is going to shrink because it has less value. So the infrastructure will become much more valuable.
Well, so a couple comments on that. Let's keep going back and forth on this one. I think this is
Sure.
practical, also interesting. So I'm not in the camp that there's less jobs in the future. I've thought about this quite at length. I could change my mind, but right now I think not because of historical precedent, that's one, but just when I think about the unknown, right? When you unleash something that creates infinite possibility, then essentially you create infinite new work that has to be done. Um and you also create infinite new blocks of time for the work that is no longer being done by a human that has to be filled. And so that will create inherently more opportunities. The caveat is there's a transition period, and that's going to be several years, maybe a decade. And that transition period is going to be very bumpy, I think, right? I think that's the one consensus most people can agree with is we don't know, so it's going to be volatile. And if I think about your sheet framework, the GNA framework, and I think about human capital as that thing, um, the bigger my population is, the bigger my liabilities grow in a hurry because not only does the value of the asset, the human capital, depreciate because now I can't put it to work at the same return because I have a, a cyber intelligence doing it exponentially faster. I still have the burden of that demographic, of that voter base, of that, and the only way to pacify them is do things that make the balance sheet worse, give them free stuff, attract, in other words, managing a large populace becomes a bigger liability in parallel to a depreciating value of that liability.
You're
Eh,
absolutely correct. So
I mean,
I disagree with you. I disagree with you a little bit about, the size of the population because obviously it's proportional, right? I mean, if you've got a country of 100 million people and 25 million are out of work, then that's 25%. A country of a billion people, 250 million are out of work. So I disagree with only that point. Everything else, I agree with you, and I hope you're right. I think that we all hope for the best and fear the worst, and I think that the amount of work that is going to be replaced by AI is huge. And I don't think anybody's going to argue that. Now, what are the new jobs that are going to come out of that? I don't know. Like you said, they're unknown unknowns. We just don't know. Let's hope that there are enough of those jobs to soak up the people who don't have jobs from the more traditional jobs. But I think that you know, your the other point that you made, which I think is absolutely spot on, is I don't think it's going to be anything close to a generation, this transition, because the first AI models are like 4 years old, 5 years old, and here we are. They're already replacing low level lawyers. It's just any sort of work that's repetitious in an office is being replaced by AI these days. And if it's not being replaced by AI, it will be very soon. So I think that that's the critical problem that is going to be faced by all governments. They're going to have to deal with this transition. So interestingly, again, going back to Singapore, what they've done is they said we have no idea which way this is going to go, but what we're going to do is we're going to give people um, you know an education credit. You go out and learn something, whatever it is you want to learn, to make yourself more valuable in the marketplace. And, is that the right answer? I don't know, but it's an answer that makes sense, right? Because I don't know which way this is going to go. I don't know if you do, but, if all of the people take different paths, then some of those people are going to pick the right path. Very much like the experiment in the US, right? I mean, the 50 states come up with different solutions to the problem, and then the other ones can copy the ones that work.
Yeah, I think of the Philippines, which I have some dear friends in the Philippines, and the business process outsourcing capital of the planet, right? Basically, ate into a lot of India's market share over the last 2 decades, and they've got phenomenal human beings there. They work hard, they're smart, they're English speaking, they're just they've got some great talent, and it's cheap labor, right? Because cost of living, but unfortunately, their governance is a mess, right? They have a governance issue with corruption, which things like that. So their business model of VAs and all this stuff is directly threatened by the current state of AI. Yet their current position in right who they're connected to and who relies on them for these things could be levered with clean governance because they already have the account. So if they can retool everyone's abilities to be the best and fastest at implementing AI, then the company's not going to go try and internalize that or do that somewhere else. They're just going to keep their account because they can do it. But if you're squandering your wealth and you're not putting it into things like that, then you're managing a populace that can't afford eggs and bread and is rioting in the streets, which is what's starting to happen. So, these countries that are poorly governed, regardless of party, and regardless of an appreciation for the balance sheet, that are enriching a handful of folks, are the ones that are going to lose. Who, is there somebody that is like an outlier that you think end runs the whole deal and is positioned to get a seat at the table that no one expects, or is it not obvious yet who that could be?
It's not obvious yet. I mean, I think the two obvious, AI superpowers are China and the US, and that's fairly obvious to everybody. I think that your point about governance is absolutely critical, and I'd like to draw an example here from Poland, and Poland came out of the Soviet orbit as a dirt poor country with very clever people. I mean, good mathematicians, good engineers, lots of scientists, et cetera, et cetera. Um, and for 20 years, the country absolutely boomed. And then they had effectively a capture of the government by a party that changed the governance framework. And the I think it was the IMF estimated that between 2012 and 2024, the change in government cost Poland something like $50 billion in balance sheet capital. So that's $1,000 for every man, woman, and child in the country. Now the country's maybe heading in the right direction, but I think what's any country that chooses to govern for the future has a chance of being the dark horse at the table. Any country that chooses to consume its balance sheet has a chance of, falling into, a trap and consume its balance sheet. And I guess the best example right now is Russia. Their balance sheet was pretty strong on all fronts. They've still got the same natural resources they had, but the machines don't work anymore, so they can't extract the oil. And oh, by the way, some of the refineries are burning. A lot of their infrastructure is destroyed because it hasn't been maintained. A big portion of their human capital has been either killed or emigrated. Um, and yes, they still have patents, but who knows? But the governance is a disaster, and they have, and actually, it's really funny because the fifth component of the balance sheet is the financial assets, and they thought they had some 350 billion dollars of financial assets, and oops, it's been frozen. So all of a sudden, you think you've got this, but your balance sheet that you thought was a fortress is now much weaker.
Yeah, I mean, and dodge or answer this question however you feel like, because the right now about the Strait of Hormuz and what happens next. At some point, a deal will be struck. At some point, um, whatever that deal is, and whenever that is, rebuilding of whatever status will either occur or it won't occur, but the strait will be open.
Mhm.
And 20% of the world's energy supply comes through that thing every day. And uh so I'm curious, when it comes to the gross national assets of a country, where do alliances fit in that layered cake? Does that fall under the governance side? Does that fall under human capital? Does that fall under infrastructure because of the deals and the kind of connection points that you can lever? Where would my alliance framework, whatever my alliances are, BRICS or otherwise, right? Where would that fit into your framework of national assets?
Wow. Okay. I have to say that was a question I wasn't anticipating, and for thank you thank you for lobbing it towards me. So let's think this through. I mean, I think that, if you look at the BRICS, for example, they have started trading much more with each other. So I think that, if you trust the other members of your alliance, then, I think that that sort of helps your governance because bring this down to the personal level, right? I mean, if I live in a neighborhood where I can leave my doors unlocked,
Right.
and I don't have to have, police cars driving down the street every 15 minutes. And, the kids can run and play in the park without having parents overseeing them. That's got a huge amount of value. So I think the same thing if you sort of scale this up to a country level. If you're dealing in an alliance where you have complete trust in your partners and you know that they're not going to do something specifically against you, take decisions that, are to your detriment. I think that that is part of the corporate the governance multiplier because it allows you to spend less money verifying that everybody else is doing what they should be doing. You still have a cost, but I mean, you could reduce the amount of money that you're spending on that verification, lack of trust um, cost to ensure that everything was happening the way you wanted it to. So I think that that would be part of your corporate governance because it would reduce the costs of doing things that you would ordinarily be doing.
Yeah, and I would imagine too that the other side of that, I love the your analogies are great because they're just so tangible. The open door lock, in my neighborhood example gives me okay, so that's one way that I can solve this feeling of my wealth being secured, whatever my wealth may be, right? Whatever my life is. Because the other way to solve it is a bunch of guys standing on the roof with AK-47s and some, barbed wire around my castle or my country, right? And that's another way to ensure it and deter it. But there's a maintenance cost to that. There's always a risk, right? There's other things. It's you know and so then there's the balance of the five families frameworks, right, which is okay, within this boundary I'm the king, and as long as you don't try and come over here and do whatever, right. The cartel framework is also a framework that is usually in governance. I think it all ties to a balance of those incentives. Obviously, everybody's hope would be that they could leave their door unlocked and walk out without worry. There are countries that probably feel that way. Europe is in an interesting situation because of migration, because of just kind of really being now at the kiddie table. Do you
Mhm.
have any do you have any thoughts on where good governance would help one of the European countries or the European Union itself kind of reclaim a meaningful place, because this is the first time in hundreds of years that they're kind of not at the lead.
Sure. And look, I think the problem Europe has is it's not one country, right? It's a continent,
Right.
and 30 countries. And I happen to be in Spain right now, but I've lived in many of the countries in Europe. And you've got a language problem. You've got different types of governments. You've got the Germans had this episode, 1940 to 1945. They were kind of unpleasant. And that's still, still comes up. How do I think Europe could make itself much more relevant? I think the problem Europe has is, probably the most aggressive country. So let's leave China out of this for now because I think China is going to be very aggressive towards Taiwan, given what's going on at some stage in the future. But I think Russia has absolutely no chance of taking on Europe in terms of, a military force. But I think Russia can be a very, very disruptive factor in the governance of the continent. So, they're already flying drones off cargo ships and doing other things, and they're hacking everywhere in the world. And disrupting things there. So I think what Europe would have to do is quite clearly there are a number of issues, and the balance sheets in Europe are actually quite damaged. And most of the damage is coming from future liabilities. So, Europe as a whole has amazing assets. The people are very educated. You've got, things that uh, people pay huge amounts of money for. I mean, how much is a bottle of champagne where you are these days? Um, so there are lots of these things that are there, but I think the governance is not at a regional level. And I agree with you that the immigration is an issue. I agree with you that Europe right now is at the kiddie table, not at the main table. But I think the only way Europe is going to get to the main table is to deal with its sort of middle term to long term issue, which is, the fact that the birth rate is going down, and the immigration that is coming in isn't really replacing the kids that aren't being born. It's people who are coming in and not working and taking advantage of the country. So you've got this welfare in many European countries. You've got a very, very substantial welfare state which is unaffordable. You've got pension provisions which are unaffordable. um, and those two things need to be addressed. So I think it's going to have to be a combination of, reducing the immigration, better integration, because, look, at the end of the day, everybody in the US, or 98% of the population, are either immigrants or descendant of immigrants. Um, the natives are a very small percentage of the population. I'm Canadian. It's the same in Canada. I mean, most of the population emigrated in the last 100 years or so. Um, but I think the problem isn't immigration in itself, because I think immigration is good. But I think the problem is, the wrong kind of immigration and the lack of integration. And I think the lack of integration is critical, because if people come in and, they start working stacking shelves in a grocery store, and then their kids go to university, and then their kids, work in an office, that's fine. That's great. But if they come in and they live in a little secluded enclave surrounded by people who only speak a language that isn't spoken in the country, then that's a problem. And it's a problem everywhere, including the US, Canada, and all of Europe. So I think
Yeah,
um,
kind of go.
integrating people.
It kind of goes back to just uh, a leadership motive which is either to control and command the resources for your own personal desires versus to build a country that is sustainably wealthy with a healthy balance sheet. And the sugar high of the former is real and can be practiced at scale. The apparatus in most of these countries, including ours, exists for that to be enabled. And yet, uh, what lasts is kind of what you said back in your earlier intro, which was you can have the highest net worth ever if you clean this up. And so cleaning up the governance and then rerouting the incentives around those assets is key. Immigration is important, but the opportunity on the other side of that has to be real. And and
Yeah, absolutely. I mean, like I said, I mean, most Canadians are descendants of immigrants. Most Americans are descendants of immigrants, and that's fine. And every generation has come in, and 100 years ago, no Italians or Irish people were allowed in certain bars. Now they're welcome with open arms. In fact, they run the best bars. So I think that. Every generation has to deal with its immigrant community, and I think in most countries, the U.S., Canada, Europe, we're not doing a very good job of it, and that's a tragedy, both for the country and the immigrants, but also from a balance sheet point of view, it's a tragedy globally because in many cases, the immigrants who are leaving, let's say a doctor leaves Nigeria to go and work in London, he's got a he's a loss to the balance sheet of Nigeria, and because he's not properly integrated into the UK balance sheet, he's not really a complete gain to the UK balance sheet. So on both sides of that trade, it's a bad deal. If he was better integrated, if his qualifications were accepted, or he had to do a course to get his qualifications accepted, and he could then practice as a doctor, then Nigeria would lose, but the UK would win. But unless that process gets properly sorted out and become systematic, then it's a loss on both sides of the balance sheet.
so, winding down, I think for everyone listening and for everyone who's tuned in live, you can find the book The Ledger by Roger Ohan on Amazon and all the places that books are sold. It's currently only 99 cents on Kindle and worth a lot more than that. I encourage you to go get it. Roger just started his Substack recently, which is why we're doing this live stream as a way to welcome him. So give him a subscribe and a follow, whether you're listening to this on replay or if you're in the live. Help him kind of get his word out there on Substack as he is brand new and starting to publish more frequently. I think the third or fourth piece dropped today. So um, give him a subscribe there, follow him, and thank him for his time today. I want to wind up with this on the practical application of this G&A framework. It seems like to me that if I thought of myself as a sovereign, which is, a lot of the work we do is focused on families that have a net worth between 2 to 30 million, and they accumulated it probably, the slow, boring way. They built a business for the last several decades, and they were able to sock away, or they were able to sell, or get out of that business and kind of take their life's work and put it into markets or wherever their retirement is, or they just, they maxed out their different vehicles as they worked the job, and they benefited from this kind of 15-20 year bull run that we've been in. And now they're trying to understand how to hold on to it. Yes, they want to beat inflation. Yes, they want to kind of leave their kids something, but for the most part, they just want to know how not to be confiscated or lose it, or not be able to recover from a potential correction that's coming. And I think if they thought about themselves as a sovereign entity, which they are, and they looked at the GNA framework through the myopic lens of their household, your framework applies. Obviously, I can extrapolate it up then to a city, to a neighborhood, to or whatever, to a state, to a country. You're working with countries, but do you agree that this is something that an individual could use just to actually understand what a balance sheet is, or have a different way of looking at it and tactically make some decisions?
Sure. So I think that, anybody who's built a business and sold a business intuitively understands what a balance sheet is because, if you're building a business, you know that whatever you're building, you're compounding something, and hats off to the entrepreneurs who go out there and build these businesses. So, again, it's exactly the same for a family or for an individual. You've got your income statement, which is how much you're bringing in, and then you've got your balance sheet. So if you take everything that you're bringing in and you spend it all and have super nice shirts as opposed to, the nice black t-shirt and the gray t-shirt that you and I have, you can get really expensive shirts, really expensive suits. You can be driven around in limousines all the time, and if your income is really high, you can swallow that whole income without building a balance sheet. But if you're building your business and you don't spend everything the business brings in, and you increase the machines you have, increase the factories you have, increase the real estate you have, whatever it is you're doing, then, that starts to accumulate. And for me, what's really striking is, the long term, if you're compounding things out at 7% a year, it doubles every 10 years approximately. If you compound at 10%, it doubles every 7 years. And that to me is an amazing thing. And in a small company, you can compound much more quickly than that. Now, your question about whether how you protect yourself from confiscation, tax increases, et cetera. I mean, every country is different. Every country has a different framework. In some countries, you have relatively high taxes, but just to take an example, the healthcare system in the U.S. If you've got a net worth of 3 or 4 million, that can be wiped out with one bad medical experience. In other countries, that's not the case. We don't outside of the U.S. You don't really have medical bankruptcies. So that's just one example of how you can protect yourself. So I think in terms of how you protect the different parts of your asset base depends on what the assets are. But I think your health is your most important asset as a human being. And we talked a little bit about human capital. If you're a family, I think the health of your family members has got to be the most important thing. Then obviously you want to have enough money to be able to live comfortably. Um, maybe some infrastructure, maybe a jet plane to go on your holidays.
Yeah, well, I think the point that I was trying to make you just made, which is that um, whether you care a lot about macro or you're just curious about it, I think this is a very practical read, a worthwhile read that'll not only help you understand the world around you better and see through the headline noise or some of the gaslighting that might be happening around the economy. It'll also just help you understand and take another look at your personal balance sheet with fresh eyes and with fresh motivation. So, Roger, thanks so much for being here on the Atomic Level. Thanks for enlightening us all. We look forward to watching your newsletter and channel grow, and we look forward to more from you in the future. So, get the book, everybody. Thank him for being here, and that's all we got for today. Thanks, my friend.
Thank you very much, Chris. It was a pleasure to join you today.
Awesome. Take care.
Thank you. Bye.